Hello everyone, this is Evan here from the Trade Risk on Friday, June 17th with a weekend market recap video. We are first going to analyze the current market environment. We're going to look at some other markets, sector analysis, and then finish off with some individual names. Now, I've been a little under the weather this week. I missed our usual midweek video recap that I put out, so I'm excited to try and catch you up with everything that has gone on this week. It's been a pretty interesting week, and I do apologize. You can probably hear it in my voice, and if this is a little sluggish, this video, hopefully we're back on track into next week. I'll be feeling better, knock on wood. Now, before we get into the content, I also want to remind everyone, if you haven't subscribed to our YouTube video, please do. Bottom right-hand corner lets me know that you're out there interested in these videos, and it keeps you up to date with all of the latest that we put out. So if you're someone who watches these videos every week, please do subscribe to the YouTube channel. I would appreciate that. Now, jumping into the action, Friday, the S&P 500 SPY ETF lost 89 basis points just on Friday alone. If we go to the weekly chart, let's start there. 1.69% loss on the SPY ETF, but remember, we did go ex-dividend on Friday, so that chart actually looks a little more bearish than it should. If we go to the cash market, you can see we actually lost 1.19% on the week, and you can see much more of a tail here on the bottom. So dip buyers did step in. That's constructive. We didn't close at the dead lows, but still not a very attractive looking week here for the bulls. And here's what really changed is last week we noticed this rejection of this further advancement in price. So right in here, this big topping tail here, we discussed that in last week's video, and we said, well, at the very least, it's a pause in the action, it's a pause in the breakout, but what we have to be careful of is if we see follow through to the downside, and that's exactly what we saw this week. We did see follow through to the downside, and notice we are back below this trend line here that is extending from the 2015 all-time highs in the S&P 500. So as it stands right now, the breakout that was in motion here has failed. We are back below that breakout level. Therefore, we have to say that it objectively is on hold. It doesn't mean that we can't make another attempt and push through 2100 and start to make a run at the all-time highs again. It just means that it's on hold. We need to see what happens here. So if you were pedal to the metal aggressively long, this week or even last week, you had to dial some of that back, in my opinion, depending on your time frame, because that breakout, that train that was on the move has now suddenly taken a break or stalled. So that's the way we're looking at this, and that's a pretty big shift right here. So we need to see what comes of it. Again, there's a little something for everyone right now because the bulls did step in and buy that dip as we came down to 2050, but yet we still are under this trend line here. So I'd say below 2090, below 2100 really is where you still just have to be neutral, kind of wait to see. It is constructive that we're basing underneath this level. So if the bulls can hold us above 2050, I'd say that's constructive going forward, but we really need to see how that plays out. So if we go to the daily time frame, you can see what happened this week. Really, we came in here on Monday and just immediately sold off the week, and then we just spent the entire week basically going sideways here. At Monday's lows was resistance, and we found support again all the way down to 2050, but most of the trading took place between 2060 and 2080, so about this 20-point handle range here in the cash market. We'll go back to the S&P 500, the SPY ETF here. Just remember, it did go ex-dividend, so that's what we're looking at here. It looks like the range, at least for now, 209, that's the top end there. Really, to get more neutral, to get more constructive on the market, we got to break above 209. Okay, so that's the bull case. You got to get back above there. And then on the downside, we have risk really all the way down to this 203.50 level, which was and is now pretty major support because there isn't a whole lot beneath us if we start to break this level. Again, this is where we found support all through April, May, and that's what set up this recent run to 210 plus. This nice rally that we saw over the past couple of weeks throughout May. So that's sort of the landscape right now. We're back to a range, we're back to some choppy behavior, and we're in a wait and see mode. And there's nothing wrong with that. You just have to understand that momentum really isn't there directionally one way or the other. We just kind of have to wait and see how we want to emerge from this range. Now, the only other comment I'll make, actually there's two more comments that I'll make. The first is, notice where we are right now. We've actually already sold off 6 of the last last 7 days here in the SPY ETF here, and I think this goes for all the other major indices as well. So we're already pretty well off of the highs that we made back in early June. We're actually almost 6 S&P points or SPY points off of those highs. So just keep that in mind, that we aren't just now starting to see some type of sell-off. We actually have already sold off, and this is where you'd want to see where the buyers step in. And again, maybe these tails that we're seeing at or around this 206 level is early signs of buyers starting to maybe stabilize us right here. And the other further point to that would be if we can put in some type of higher low here as opposed to coming all the way back down and retesting this 203.50 support, that would also be constructive to show that there's signs of bulls trying to keep momentum up here in the top end of this range. So that would be something constructive to keep an eye on heading into next week. The final point I'll make is on Friday we actually had the high cap stocks take a big beating. So that was Apple, Google, Amazon, Facebook. Those stocks, $200 billion plus market cap stocks, were all down 1%, 2%, 3% on the day, and that put a lot of pressure on the indices. So really, breadth on Friday was actually positive. In other words, there was more advancing stocks than declining stocks on Friday. But if you were to only look at the indices and the percentage basis of those indices, you would think that things looked a lot worse out there. So my point is, take the beating in some of those high cap stocks, take that along with the ex-dividend going off here on with the S&P 500 SPY ETF, and you really have those two sort of illusions that kind of make us look a lot more bearish than we really were closing out the week. So just keep that in the back of your mind, those 2 points. They are important points, and all these things kind of give you some more context about the market. Now let's take a look at some of the other indices here. In the Qs, feeling the pressure from those high cap sell-offs that we just talked about in Apple, Google, Facebook, those types of names, actually down 1.43% just on Friday alone, and actually finished down 2.25% on the week. So on a weekly closing basis, Qs underperformed all the major indices, and you can see now the lower high that we talked about a couple of weeks ago here is starting to play out, and this underperformance is taking shape. Really now, what we need to be careful of when we're looking at the long-term structural kind of viewpoint here on the Qs is this 105 level is going to be very important now for us to hold on to, and it looks like we're racing down there, and we're going to really need to see if bulls can support us at 105 like they did in May, because if we start to really roll over from here, then this market as a whole is going to be in trouble. So the Qs right now are the underperformers. We could still make a case now, objectively, we are still certainly range bound. I don't think there'd be any conflict in saying that right now, perhaps moving sideways in this type of holding pattern. Let's see how it acts down here, and perhaps we get support and we can rally back higher and everything looks good again, but until that happens, we have to be cautious and suspect of the Qs. The IWM, on the other hand, is probably the most constructive looking, still lost 1.73% on the week. However, you can see on a relative basis, it's still actually trying to hold on to its 20-period EMA right now. It's trying to put in what looks to be a higher low from this nice rally that it had throughout the third week of May, about all the way to the first week of June. This nice run up from about 108 all the way up to about 118, 10-point rally, and now it's coming back, retracing 50% of it or thereabouts. So if you can hold here, that would be nice and constructive win on the small caps. So you got the small caps trying to lead us, outperform. The Qs are lagging, the SPY somewhere in between. Now let's get into some other markets here. TLT saw a nice rally this week, although a little bit of a fade here at the highs. Still closed up 62 basis points. Was up a lot more in the week, all the way up to mid 137s. But you can see the picture here still looks good. We're coming back in and retesting these early 2015 all-time highs here in the TLT, and you can see, is this going to be some type of a lower high retest right here, and that's all she wrote for TLT. It could be, but betting against TLT so far has been wrong for the past many years, so I wouldn't want to start now. It's still above the 8 and 20 EMA, still trending healthy, perhaps overextended, needs a little bit of a break. Back to the daily chart now, you can see coming back to the 8-period EMA, could use a pause. Again, I wouldn't want to be betting against this just yet. I'd be more interested in buying a dip than I would be trying to call this the very top here. So just stay with the trend there. But for now, TLT looks pretty strong to me. If we look at gold, you can see basing now at the top end of this recent healthy consolidation. I think the weekly picture really shows it all. You have this nice upside channel breakout here, and then we're just going sideways, basing above this upper trend line here. That's healthy action, and even though we did get that fade, it was still a new all-time closing, a new closing high for 2016, I believe, or very close to it. 123.95. Yes, it was. So new closing 2016 weekly highs here in gold. That's constructive. We want to see if this trend continues. 8 and 20 still in very bullish alignment. Look for continuation higher there. Silver, similar situation here. Pattern a little different, but you still had that nice breakout here throughout April. Had a deeper retrace and retest. We found support at the 20-period EMA, and now we're coming back to those recent year-to-date highs. Not quite at year-to-date highs. We had a pretty violent day yesterday on Thursday, but still you can see we're at the upper end of this range here, and we're near 2016 highs in silver as well. So looking constructive there. USO did manage to break down from this rising wedge, but it did have a fierce snapback here on Friday, up 4.67%, leaving in the dust this close here, trapping probably a lot of aggressive shorts here that were taking positions towards the end of the day and throughout the day on Thursday, as we gapped above all of Thursday's action and closed at the highs. I like that as sort of a trapped sort of signal right there. And if we can get back above this trend line, back into this wedge, perhaps we do continue, and perhaps that gives us the fuel to continue on higher here. So keep an eye on USO. Very interesting developments here as it broke down, and then it's quickly trying to come back and reclaim it. UNG is just holding very sturdy up here near the highs. This is one we're still long. UNG, we have taken profits. We got in long here. We did take some profits on this big spike day around 785 or so, 788, somewhere in there, and we still have a good chunk of this position on. It looks good. Looks like it's ready to try and break out again. Beautiful consolidation sideways, let these fast-moving averages catch up, and now it's trying to make a move again. Let's see if that can happen next week. Finally, we'll look at UUP, the US dollar here, which is still messing around with this big 2450 zone. Again, weekly chart kind of shows this previous support level. Still dancing around here, hasn't really made up its mind as to say if this is going to be the lows getting put in around 24, or is it about to roll over and convincingly lose this support level. That's what we're still waiting on heading into next week. Now, getting into some of the sector analysis, this week was really the rate-sensitive defensive plays. IYR standing out, up 64 basis points on the week, holding up very strong there. Utilities also holding up near the highs here, also very strong. And energy still held in there overall on the week, down 71 basis points, but still on a relative basis not so bad. So it's trying to hold on to this support above 65. I think it's still constructive. If it starts to lose 65, I think you need to be cautious. On the downside, on the weak sectors, you had industrials down 1.31%, and a lot of them underneath the hood were down even larger on the week. So industrials certainly interesting. If it starts to lose 55, that's when you'd have to be concerned. I think you're still in a fine just range-bound sort of consolidation phase, but if it starts to lose 55, I think you got to be cautious there. Financials continue to be a mess. They actually lost convincingly some support back here from May. So just like as we looked at the S&P 500, where we said, well, we need to see if it can hold those May lows. Well, XLF, the financials, actually already lost those levels. So you're seeing underperformance in financials. You're seeing a failed breakout here in the financials a few weeks ago as it tried to poke its head above this trend line. So now you're convincingly losing the 20-period EMA on the weekly chart. You're starting to see the 8-period curl back over. So financials, certainly a weak sector right now, and healthcare, particularly IBB, certainly weak as well. Look at all of these sell days just being stacked up on one another and haven't really seen any strength. We're coming back into this support area down here, this trend line where we found levels right around this 250 to 255 zone that has been support. So we would expect perhaps after 7, 8, 9 days of selling off like the IBB has, to find some support down here, and we'll have to see if that actually happens heading into next week. Now, looking at some of these individual names, let's go through those. Apple getting smacked here on Friday, down 2.28%, and starting to look pretty messy and starting to look like it has a date with a retest of this $93 level. If we go to the weekly chart, you can see we had that false breakdown here about 5 or 6 weeks ago at the middle of May, where we broke below this $93 level, and then the next week we had that news with Berkshire Hathaway taking a position, and probably some other things, and that really kind of pushed us, squeezed us higher back above this breakdown area, this prior support level, and then we had a nice rally up to $100, and now we're starting to roll back over. So we'll have to see, can the bulls put in a higher low? Can $93 hold this time as support? If it can't, then of course Apple is going to be in trouble. So keep that on watch. Let's see how that unfolds next week. Certainly in a vulnerable spot. Looks like it could head lower, but we'll have to see what happens next week. Google certainly seeing a really potent down move here on Friday, 2.76% down move in Google, all the way back down and basically tagging this $700 round level. And this is a very important level for Google, and it doesn't bode well if we start to crash below and break below these levels. Crash is not the right word, but break below these levels is when you'd have to be concerned for Google. You can start to see the 8 and 20 period starting to curl over. We were previously range bound up here, so what you don't want to see is a breakdown below here, signifying that this was one big distribution range in here by some of the bigger time frame players. So that's going to be very interesting next week to see how $700 holds up. Going to be very important for that stock. Amazon also under pressure, 1.55%, still holding up very, very, very well, all things considered, down 1.6% on the week, and still just barely now losing this 20 period EMA. So still above $700, still in the grand scheme of things is certainly the strongest of the bunch. But let's see now if this is going to start to put in a multi-day, perhaps multi-week retrace lower. We'll have to see how that holds up. So keep that one on watch. Netflix, very quiet. I'm just putting this one up here because it is so tight right now, and something has to give here pretty soon. This is unusually tight action in Netflix. So I think, even if you're a day trader, swing trader, whatever you are, I think there's some opportunity here at the lower end of these bounds. If we start to break below 93 and a quarter or so, I think you have some type of breakdown trade. If we start to lift above 96, I think you might have a breakout trade. Just have some real tight action here, and I think that's something you could probably key off of next week. Longer term, it's just in a big messy range. Not too much to say about it beyond that. Facebook also coming back down and firmly trying to fill this gap here from earnings back in April. It's starting to roll back over a bit. Weekly chart, you can see coming into the 20 period EMA. Let's see how it holds up here next week. Twitter is one that actually has a bright note, finished up 1.45% on the day on Friday, so bucking the trend going the other way. Weekly chart, you can see actually closed up almost 15% in Twitter. Very impressive. And you can starting to see now the gap fill is not quite finished, but largely underway here. And you can also see this bottoming pattern that could potentially be, a nice trade to the upside if Twitter can convincingly break above this $16 level. Did a nice job at showing some relative strength this week. Let's see if it continues into next week. It would be nice to have Twitter in play on the long side again as a trading vehicle. We haven't had that in seems like an eternity. So we'll have to keep an eye on Twitter heading into next week as well. And that's all I have for today's video. Thank you guys for watching. Again, please do subscribe bottom right hand corner if you like the videos. As always, thanks for watching. I'll catch you next time.